Okay, good morning, good evening, good afternoon, and welcome back to the 2022 Master Trader Program with Mark Minervini. My name is Bob Weissman. This is day 2 of the workshop, and we will be going through a curriculum today as well as a question and answer session. I will share with you, we got a lot of questions from you, but today's questions for that question and answer session will be on the material that you watched yesterday as well as today. We will have a break after the curriculum is over, which will be about 3 hours in total. We'll take about a 30-minute break in between the curriculum and before we start the question and answer session. You can, we'll give you details if we're going to need to restart the room for that or not, but otherwise I'll give you that update in a few moments. Today's itinerary, as you were sent, is going to be just one quick break, not quick, but a 15-minute break in between. There's only going to be one break today between the two sessions. A first reminder, though, that there is no recording or of any kind or distribution of any of the material. Any video or audio recording is a strict violation of your terms of attendance. And today's workshop is, of course, brought to you by Marcus Smith, who is our sponsor. We will have Scott St. Clair from Marcus Smith coming on the live trading day to go over their product and to show you some of the features of it. And Mark will also be showing you how he uses the product when we do our live trading day on Monday, November 21st. There will be a replay of today's session this evening here, 6 p.m. Eastern time, and that will include the question and answer session as well in that replay. And today, the 2022 Master Trader Program is brought to you by Mark Minervini Private Access. Today's session will start, let me just see, on page 143. And that is the low risk entry point. This first section is going to be lengthy. It is going to be the better part of an hour and 45 minutes or so. Of course, depending upon the material, we'll take that 15-minute break, and then we'll have the last section for the day, and then we'll get into the question and answers. I am organizing all the questions. Remember, just try to do it on the material that is being presented yesterday and today. Some of the questions that I did receive from you were about questions that we have not yet reviewed or discussed with you. So we will have another question and answer session on day 3, following day 3's curriculum on Saturday next week. So with that said, give me one quick moment and we'll be getting ready to get started. And looks like we are ready. So let's get started with day 2 of the Master Trader Program. Let's get back to Mark and Mark.
Okay, welcome everyone. Welcome back. 2022 Master Trader Program. I'm here with Mark Ritchie. Hello, Mark.
Hey, Mark.
We're still on workbook number 1, and we're going to just dive right in here. We're going to go to page 143. We're going to talk about timing a low risk entry point, and we're going to discuss the volatility contraction pattern, because this is something that I use. It's a characteristic, actually. It's not actually a pattern. Well, I guess you can say it's a pattern, but it's a characteristic of a pattern. Like a cup with handle would have volatility contraction characteristics. And one of the reasons why I even came up with this was simply to teach others on how to identify constructive price bases when a stock was consolidating. And so we're going to talk about this series of contractions that happen while the stock is moving sideways, and there's a reason behind it. There's a very good reason why we use it, and why we use it almost exclusively. Virtually all the buys that I make and Mark makes, and even David Ryan, we're all looking for volatility contraction and buying from the right side of the base when volatility is very low. Volatility is not your friend. If you're a low risk trader or investor, you want low volatility, you want high alpha, low standard deviation. You don't want a lot of volatility because volatility is risk. And when we're using very low risk entry points using tight stops and so forth, volatility is what will cause us a lot of grief. So we're going to show you how to trade the stocks that have that volatility contraction, and when they're coming from not only from a low risk standpoint, but when they have very explosive potential. So what I'm first going to do is I'm going to show you some examples, explain the volatility contraction, the contraction count, which I call it. And again, each of these counts, if you will, I used to refer to them as C's. Now I call them T's, tightenings. Basically, what they are is just each time the stock from peak to trough corrects, and then peak to trough corrects again at a higher level. So you have a higher low and a tighter range. So for instance, and like I said before, I'm going to show you a lot of stocks that we previously looked at. So, we'll look at some of these stocks that are in uptrends, then we'll look at them versus the general market, look at the relative strength to see if they're showing leadership characteristics. That was in the next section that we looked at some technical analysis. We looked at fundamentals and applied those to some of these same companies. And now, of course, we're looking at the base and the volatility contraction pattern that's within that stage 2 uptrend. It's real important that you think chronologically that all these charts that we're going to show you now and all these price patterns are going to be where you're already in a stage 2 uptrend. Okay, that's already been decided. You've already made that decision. That's your qualifier. So again, this would have a different meaning or a different connotation if these stocks were in a downtrend. If they're in a downtrend, a volatility contraction could actually be a short if it breaks to the downside. So real important for you to keep that perspective. So as you can see, these little red dots, these are just from here to here. That's would be your first correction in the stock, and you rally back. Your second, and you rally back a bit more. And now where it gets really, really tight. One of the keys about the volatility contraction, at least from how I trade it and how I've found that the grand majority, 98% of the stocks that really take off and make big moves, they generally they'll come from the tightest portion of the volatility contraction is single digits, and you can see here, of course, looking at WR Grace again, 29% peak to trough was the first pullback. Then as it rallied, it came back and it was only 9%. Now that would get my attention. That kind of tightness would get my attention, and it did because I bought this coming out right here. And then, of course, just a 3% tight little range, super, super tight. And that's exactly what I'm looking for. You'll also see that you got off to a really nice start here. And this is another benefit of the volatility contraction and coming in when there's very low volatility, low volume, you get that explosive potential. Like I said, I'm going to explain to you exactly why that happens in just a minute. But we're looking for a great start. We really want to get out of the gate, if you will, and get at a profit as soon as possible. As a matter of fact, when David Ryan was here in previous years, he always used to say that's the number one thing that lets me know that I'm on the right track and I'm probably going to make money in the stock is that I'm up right away at it, right away on the position, and that tells you that your timing has been you timed it correctly.
Another golden nugget there, Mark. And I just want to add, that's, I think, also another timeless principle, because even Livermore alluded to that too. Back, 100 years ago was the same idea of, focusing on being right away. I just wanted to point out, though, this is a great slide for the difference between alpha and volatility that you were talking about. A lot of people, especially beginners, and I was in this camp, think, if you look at that arrow where Mark says, I'm buying here, ooh, that's volatile. No, it's not volatile. It's one-way price action for the first 2 days straight up. That's alpha. That's what we're looking for. And to Mark's, volatility is where it's cutting back and forth, up and down. And we want just the opposite, where it's tightening up, and then you get that burst of alpha in your direction as it breaks out.
Yeah, if you had a stock that went up 100% in 10 days and it just went up, 10% a day, let's say, for 10 days and went straight up, and every day it closed up, there'd be no volatility whatsoever because it's all on the upside. So that would be all alpha, excess return. So volatility, as Mark said, has to cut in both directions. The volatility is when the stock is whipping back and forth. You have to have upward movement and downward movement. And what we're trying to do always is create asymmetric leverage where that upside is much larger than the downside, and even we're cutting off that downside and then staying with the stock. And you can see clearly how we get off to a great start, but see this big move here where you've got 100 and almost 150% in 55 days. But look at all the pullbacks. There's not much pullback in the stock. So even as the stock progresses, the downside is limited relative to the upside. And that's where we create that alpha. We want to be involved in stocks that are having those nice moves up and giving back very little. And that's standard deviation too. We want high alpha, low standard deviation. We'll talk more about this later too. So FSI International, this was another one that I had bought and purchased going back in the 90s. As a matter of fact, in 1995 was one of my biggest years that I ever had. Certainly around that time, I was up over 400% that year. It was a real game-changing year for me with my personal account. And I bought this stock, and you can see on a weekly, came off about 18%, rallied back, and then just 5% on that right side. And this took off 130% in just 7 months. I'll show you the daily. This is where I was buying it right here. And this really sticks out. I mean, you can see it's incredibly tight right here. There's just no volatility whatsoever. And again, look at this wonderful start that you have. 1, 2, 3, 4, 5. It's like 6 or 7 days up. So once you get that type of start and the stock comes out of the base and breaks out and you're at a profit, what it does is it takes all the pressure off of you. And even creates a short-term situation where if you want to take the profit, you certainly could. There's a lot of traders that use this type of method, use my method or shorter term, and they're selling right into that. But again, even if you're going to play it for a bigger move, you now can go through pullbacks without much pressure, because unless it comes all the way back down and were to go back to your break even or stop you out, and that would tell you that there's something not right with the stock, because once the stock comes out that strong, it shouldn't reverse everything. And so again, that first move, look at the relative strength, just really outperforming the market. The market was moving up too at that time, but this stock was moving up a lot more. And that's that leverage we were talking about. So you want to get that leverage right on the hop, and then hopefully you got your tiger by the tail, and you're gonna leverage the market. Let me show you some more examples. I'm going to show you a bunch of examples, and then we're going to dig deeper, and I'm going to show you the nuances of the volume, the price, and really start to get more forensic. But I want to first explain and have you see some of these precedents, which you can use. You should be using these. This workbook is very valuable to use in the future. Mark, you've been to a bunch of these, as we said before. In the very first one, how did you use the workbooks and maybe even my books as precedent models?
Yeah, absolutely. Great point. I was going to make, and my laptop is actually sitting on a stack of old MTP manuals. I have tons of them that are full of notes. And one of the things, I did, especially after the first few years, was just page through all the different examples. And we're going to get to this a little bit later in this section, but the idea is just training your eye on what to look for. One of the other things David Ryan used to talk about is the idea of just focus on studying the perfect examples. And that will weed out all the other stuff. We often get questions, well, what shouldn't I do? Don't focus on what you shouldn't do. Focus on what you should look for. That'll solve, 90% of your issues. But absolutely, and the other section in Mark's first book, that gets into some of the philosophy, the technicals, which I know we're going to get into again, is also really important. But these precedents, you just got to hammer them, get that blueprint, embedded into your brain, so that as you start screening on your own, you're just training your eye and what to look for.
Yeah, absolutely. And that comment that you made about David Ryan, David used to say, when they used to teach people to look for counterfeit bills in the government, they would study a perfect bill. and then compare the bills to a absolutely perfect bill. And as opposed to looking for all the things that can be wrong, just start with what a perfect bill is supposed to look like and compare and contrast. And that's what you can use these precedents for, because you're going to see they repeat, and they may not be completely exact, but you'll be amazed at how similar these setups are. You'll be saying to yourself, why doesn't everybody do this? If it's everything is so repeatable, and there's a reason behind that too. And most of it's with regard to discipline. But again, very tight here. There's right here, 7% from 20 to 7 to 2. So this was so tight and had so little volatility that I bought this coming right out here. And you can see already previously in a stage 2 uptrend. Let me give you a few more. And one of the things I want to point out too is that generally what you'll see is you'll get 2 to 4 or 5 contractions or corrections in the stock, where you come off here 1, 2, 3, and it gets really tight. That fourth one, I've seen them go 5, 6. Very rarely do they go 6, 7 or more. Usually it's between most generally it's 2 to 4. Sometimes you get 5. Very, very rarely you get 6. And if it goes more than 6 or 7, starts going 6 or 7, it's usually getting abnormal. So again, most of these you'll see that they contract about 2, 3, 4 times. But again, that's what forms, as we've talked about before, and Mark just mentioned Livermore. That's what Livermore referred to as the line of least resistance. And again, nice quick profit here. See, very explosive, right? And again, there's a really good reason behind that, which I'm going to show you in just a second. This was actually a stock I did buy. It says buy point here, but I was actually buying that right there. Cena Corporation. So here's one that's a little larger. And generally, when you get 5 or 6 contractions, it'll be a larger base. And I love those. I love the really large bases that have a lot of tightenings, a lot of contractions, and then at the right side they get really, really tight. Those have really explosive potential. They've given the stock enough time to go through a very natural process of changing hands from weak hands to strong hands, and then when you finally, the supply is really weeded out of the stock and there's no more selling, it's free to move even on a small amount of volume, and it can really blast off. This stock went up 52% in 23 days. And as I pointed out before, I refer to super performance, not just these big monster stocks that go up, secular, but even if a stock can go up 20 or 30% in a couple of days, wow, do the math, compound that. You don't need many of those. So we're looking for not only magnitude moves, where you get these long secular moves and the stock goes up hundreds of percent or thousands of percent, but also what we call velocity moves, where very quickly you can pick up 30, 40, 50% in a matter of days or weeks or even a couple of months. Can really could add up, and you can compound. All right, let me explain to you why this volatility contraction is so important, and why getting it right and really learning how to do this could really be very valuable to you. The first thing you have to understand is that this is not the effect. Okay, this is not the cause. I'm sorry, this is not the cause. This is the effect. All right, this doesn't work because people are watching it and it's popular. As a matter of fact, it would be just the opposite. But it is the effect of supply and demand. And what happens, and when you look at these charts, now these charts are just human behavior on display. And so if you start to understand what's actually going on there, especially at key points within the chart, you really start to have the confidence, to utilize this, because you'll understand that the reasoning behind it is very sound. It's rooted in the most fundamental of all fundamentals, and that's supply demand. There's nothing more fundamental. It's like gravity, the law of gravity. So here's what happens. A stock will start to correct down that left side, and inevitably you'll have people that bought the stock around the highs, and so as the stock comes off, they're at a loss, and we call them trap trap buyers, right? They bought the stock, they're very quickly at a loss. And now somewhere around the lows, where the stock starts turning up, you'll have buyers along the way, and some of them would have bought around the lows or somewhere around the lows. And as the stock comes up the right side, you get a merging of the two that create supply. You get, first of all, these people that bought around the lows are at a profit. So you get some short-term profit taking, and that creates some selling, of course, and that intersects with some of these trapped buyers that are starting to get back near their break even. And as they start to recoup some of their losses or get back to break even, that creates some selling there. So now that creates that next pullback in the stock. So you get another, that would be the next pullback. But now, because you've weeded out some of that selling, so there's less supply, you don't correct as much. You correct a little bit less. And that same process happens all over again, only now you've got less buyers at that high because it spends less time, and you've got less buyers around the lows. And when you come back, that whole thing starts all over again, where you've got the trapped buyers and the profit, the bottom fishers taking profits again. And now it goes through that another iteration. But because you've weeded out even more supply, there's even less. So now the pullback is even tighter, or and even shallower and quieter, because there's less supply, less volume, until finally you get to where it really quiets down. And this is what lets you know that the combination of time and price and volume lets you know that the stock now has limited supply. There's very little supply versus where you had all this volatility. Now, and it's not perfect. I mean, could there be a big seller at a certain price? Sure, there could be, but it gives you a really good indication that supply has stopped coming to market. And when you get this supply imbalance, now this is all predicated on the fact that this is a stock that's in an uptrend, and you've got that institutional sponsorship that we're looking for. There's an appetite for this stock, and if you've got big earnings, you've got big sales, and you're in a strong uptrend, well, that increases the probability that there's something going on there, and there's an appetite for the stock. So now this is an intermediate or short-term correction in the stock. So what you're trying to do is get on board once you weed out these shorter-term players. And now the longer term trend, you're trying to get back in sync with that long-term trend, but bypass all the time to wait for it to go through that volatility and move sideways, because time is money, of course. And that's where when you have the institutional support and you have the supply demand imbalance, where you have very little supply, well, very simple, low supply and demand, low supply, big demand, explosive potential. As a matter of fact, if you have really low supply, even a small amount of buying will move the stock. So when volume comes into it, it just explodes. And that's why you'll see, all these charts that we're showing you, they come to these buy points very quickly, and you get at a profit very quickly. And that's our goal, to get at a profit as fast as possible. Before I go on to this next slide, anything on this one, Mark?
Well, this last concept is really important. And, again, the section in your book where you go over this is also, I think, for people to understand, that the pattern isn't causing anything. People think, oh, this VCP causes it. The VCP is just the effect of stronger hands are taking that supply from weaker hands. So in each of these iterations, where Mark is showing, as you're going up the right side, those stronger institutional hands are slowly gobbling up the supply from left to right. And then the most important point is when he was talking about, again, the reason we start with the stage 2 is you got to keep everything in context. So, and that WR Grace example is such a good one. It's already in that that longer term uptrend. Then you start to see that supply contracting from left to right, and you've got a really powerful cocktail then as the volume starts to dry up on the right hand side.
Right. The bigger buyers are absorbing. They're absorbing
Exactly
that
right.
supply, is what Mark is saying. So let's put it another way. Let me show you another way. This is often an explanation that people really can understand and love. So again, trapped buyers, bottom fishers, profit takers, and break-even sellers. Right. So think of it this way. If you ever take a towel and soak it in water, and you pull it out of the water and it weighs a ton. And then so you twist it and you wring all the water out and no more water comes out of it. But then you untwist it and retwist it, and then more water comes out, but less water comes out. And then if you unravel it again and you re-ravel it again and you twist it again, more water comes out, but even a little bit less. Each time it seems like all the water's out, but it's not really out. And so you untwist it, retwist it back. So this is the same exact thing that happens with when you go through this VCP. As you're going through these iterations, it's wringing out the water. Think of that as supply. It's wringing out the supply a little at a time. And then when it comes off a little bit, it comes back. You go through that same iteration. It's like unraveling the towel and retightening it, and a little bit more water until there's virtually no water or very little water. And that's where we come in. That's what we want to try to get involved in the stock. Now, what we're trying to do here and pass on to you is to create where your vision, when you look at charts, you're looking for a footprint. You're right away, as soon as you look at a chart. I mean, if Mark looks at a chart and I look at a chart, it's really quite amazing. And even David Ryan, we could all look at charts and we'll spot almost all the same names. I mean, I can tell you, Mark, how many times do you say, I say, you know, what stock do you have? And you say, oh, I bought XYZ. And then I'll look at the chart and I'll pinpoint the exact day you bought without you ever telling me, right?
Yeah, we've played that game many times, and usually you run a perfect card.
Yeah, because there's this footprint, there's this look, if you will, as David Ryan used to say, you know, the look has the look. That look is something that we can look at a chart and right away know if it's got that footprint, because we're looking for that silhouette first. Then we get more forensic. But think of it this way: you know, if I told you, you know, this guy Jim I know is 6'5", he's 284 pounds, he's got a 46-inch waist, 54-inch chest, you know, wears size 13 shoe. Like, you wouldn't know exactly what Jim looks like, but you'd have a pretty good idea, you know, of his build, and he's a big guy, and you know, you'd get a good idea of a silhouette. Well, that's the same thing with this, where you're sort of your starting point, and this is what I call the VCP footprint. So this little acronym, if you will, right here, or abbreviation, where it's 40W 31/3 4T, that's basically just explaining, you know, what this VCP footprint is for this stock right here, this VIVO. So what that means is it's a 40-week base. So it's 40 weeks from the start of the base to the completion. And the largest, 31/3, is the largest decline in the left side. And the tightest to the right is 31% and 3%. And there's 4 contractions, 4 T's, 4 tightenings. So with that, if you just told me 40W 31/3 4T, I would immediately be able to visualize that chart. And I know it's a pretty big base. It's not very deep in the first pullback, and it's really tight on the right side. And it's gone through 4 iterations. Like, I would be interested in that if I just saw that abbreviation. So I created this abbreviation. So whenever I now, you know, I used to do it on just a pad and pen, and as I was going through the charts, I would put down the abbreviation, and then I could later on, as I'm looking at the stocks and I'm watching them trade on my Quotron, I would know, you know, which ones were which. So think in terms of the footprint. I'll show you. Here's Netflix. So I was buying Netflix right here, and you know, quite basic, you know, 27% in the first decline, 17% from here to here, and finally an 8% with a real little tight little area right here, which actually you could probably call this a 4T. And then just as it comes out of here, that's where I'm buying. I'm buying right there. And of course, this stock went up. We talked about this before. Netflix went up over 500% in just 21 months, and then made a much bigger move after that. That was only the tip of the iceberg. If you take a look on a weekly, here you go, 27W, which is 27 weeks. 27/8, 27% on the first contraction, and 8% on the last, and it went through 3 iterations there. And you can go ahead.
To point out too, Mark, that you know that you have the volume highlighted in the bottom.
Yep.
I think 2 of those weeks were the lowest weeks in certainly in the entire basing period, but also since sort of the beginning of that move.
Yes.
That's exactly what Mark was talking about. As it's tightening, that supply is drying up.
Yeah, very good point. And so with the volume, sometimes the volume will come down, especially if it's a smaller mid cap stock. It'll come down to almost nothing. And this sometimes scares people. They're like, "Oh, I can't buy that. It's so thin." But you want to look at the average volume. That's the first thing when you look at volume for this, for making a decision whether a stock is too thin or not. But you want that volume to come down as much as possible. If it traded no volume, that would be the best scenario, because that just means that there's no supply at all. So when you look back and you look at the base, sometimes you'll find it's the lowest volume in the entire base, or even in the entire move since the stage 2 uptrend. When you're gauging these things, you want to gauge them against the basing period, and since the stock has moved into a stage 2 uptrend. So you see here, stock moved into a stage 2 uptrend. Since it moved into a stage 2 uptrend, that's the absolute lowest volume. You got a couple of the lowest volume bars since that stage 2 uptrend. That's exactly what we want to see. That's teeing it up perfect. Let me show you another chart here, and you can see how we come off here, and then we get really, really tight. It comes right out quite nicely. Right away, you're at a profit. And you can see the volume here, really, really low volume. It's some of the lowest volume. Again, if you go back to the chart here, and you can see it's the lowest volume. It's the lowest volume since you got into this uptrend, and it's the lowest volume pretty much in this base. And then you see the volume comes in, and that's the next thing you want to see. You want to see volume come in. Once it starts moving, we want to see if there's actual appetite for it. So now you get that combination of low supply and now heavy volume coming in, and that's how it gets explosive. But here's the thing: we go back to what Mark was saying. This is timeless, and it doesn't know time frame, because again, this is not the cause. This is the effect. And if you're using intraday charts, daily charts, weekly charts, this right here, what you're seeing is just that, from that area to that area in this one bar after this new issue. So this is just a 5-minute chart. So you see the exact same thing unfolds, even on an intraday chart. As a matter of fact, we have a lot of customers and those that I've instructed over the years that they day trade, and they use these techniques to day trade. You can use them, in that fashion as well.
I'll just add, Mark, too. One of our colleagues, Bob Weissman, he messages me all the time going, "Did you see the little VCP on the 5-minute on XYZ stock?" And I'm always like, "Bob, I don't day trade, of course," but you just see it all the time. I mean, if you learn to master this concept and become a specialist in identifying these areas, you can make a career really regardless of time frame. And people will be doing this. They've been doing it before we were here, and they'll be doing it when both of us are dead and gone. This is a timeless principle.
Yeah. And Bob is something many of you know. Bob, when I first met, Bob's been with me for, I don't know, almost 20 years now. When I first met Bob, he was a day trader. He was day trading exclusively. So he to this day always goes back to those day trading roots and always spots things on an intraday basis. So now you can also get multiple buy points where you'll get these tightenings will happen, and we're gonna talk about this in more depth of the various buy points that you'll have and the opportunities that you'll have. When Square set up, it was pretty shallow to begin with. It only came off about 13%, which would get me interested just in that alone, because it's not correcting very much and showing that it's strong. But you can get multiple buy points, and you see here just a 5% pullback. So it's already really tight, then it rallies up a bit, and you get another little pullback here of just 3%. So 2 really tight points here. And everything that we do, whenever we're buying, we're always buying within the base or just coming out of the base, within the VCP progression, or just coming out of it. Once it comes out of the base, that's it. We're leaving it alone. We're not chasing it. We're not buying gaps and all these. That's, maybe there's other strategies that you can do that, I guess. But we're looking at it within the base, and we only want to be buying within the base, because that's where the move generally starts. That's where you'll get that explosion, and you'll get that start of the move, and that's where risk is the lowest, and that's the key. We want to keep the risk really low. So I want you to look at a few things on this chart. Look at the volume and the price and the contrast between them. So even right here, you can see really low volume, right? So there's really a lack of supply here. And it looks like the stock is just waiting for the earnings to come out, because when the earnings come out, EPS of 109%, look at the volume that comes in, millions of shares, it just explodes. The stock has a 2-day run. So this is something that would get my attention, but I wouldn't buy the stock here yet because it hasn't gone through the VCP. Now over here, it actually did go through some VCP, characteristics where you got really tight. You were heading right into earnings, so that was kind of risky. So here now, once the earnings are reported, you go through a nice VCP. You get real tight over here, and you can see even over here where it's tight right here, the volume's low, and then you get that contrast. See, this is where you really see the contrast, where you have low supply but big demand. And that's where you can see that contrast here. You can see it here, and you can see it here. And you should be looking for it all along the way, within the chart, where you'll see that. Now, on the left side of the chart, when you get into big corrections, there will be big volume on the downside. And when you see that, you want that to be on the left side. That's okay. As you get to the right, and the further to the right, and you start really tightening up, that's where you want the volume to come way down. So all this, as I'm going to go back to what Mark was saying, all this, what we're showing you, is to culminate to where we want to get you to a point where you're looking through basically the eyes of a template. So when you look at a chart, there's this template that is sort of like you put glasses on and you've got the template superimposed in it, and you look at charts and you're trying to find the chart that fits in that template. So I let the stocks come to me. I go through my screening process and I look for these stocks, but they've got to fit that template. They've got to fit the VCP template and have those characteristics, and they've got to be first in a stage 2 uptrend. So the first thing we're going to do is the stock has to be in an uptrend, has to meet the criteria that we spoke about earlier, and it's in a stage 2 uptrend. That improves the probabilities and gives us an indication that we've got institutions in there. We need that demand. Definitely need that demand. Then
I'll just add too, Mark, this whole section, I think, for folks, if you think of this whole section on the VCP as really learning how to put those glasses on properly and to look through them, it will, if you really learn this and master it, you will eliminate 99% of the stuff you don't want to be looking at. I screen hundreds of charts a day. Doesn't take me that long because, my glasses aren't as refined as Mark's, because he's been doing this for 40 years, but they've gotten pretty good over the last, 12, 13 years. And that's really how you want to be thinking about this. It's going to slowly and steadily train your eye for what you really want to look for and finding those really opportune situations.
Yes, Mark has gotten good enough to make tens of millions of dollars, so he's gotten pretty good at it. and again, he's armed with the same information that you're getting. As a matter of fact, you came to the first Master Trader program, Mark, and it was I think the workbook was probably half the size of this. It was like 200 pages, and now we're at like 5 change. And we've refined it, and so much more. There's so much more now. And so again,
the irony, Mark, too, is a lot of it now. It feels like in the early days, I was just looking at all those examples. Now, probably half the names, most of the names from the last decade are all names I traded, or a lot of names I traded. So
right.
it is amazing. You look back and things have kind of come full circle to go, well, I saw that in real time. I saw the tightenings, the contractions, and I was able to get on board.
Yeah, absolutely. And you lived through a lot of this. Again, yeah, most of these examples, we've traded. So now, again, another thing you want to, now we'll just recap real quick. Remember, stage 4, you're losing time and money. Stage 1 or 3, you're losing time, and stage 2, that's where you're gaining value at the fastest pace. That's the only stage you want to be in. So now, once we get into that stage, you're not going to have just one opportunity. And there's some earlier opportunities. Obviously, the earlier to get on a big move, the lower you're getting the price, and it would be a larger move. But sometimes the later stages, for instance, even here, you could see you move up a bit, but then the second opportunity that formed the VCP is very explosive, and you get a chance to have a very quick gain. And sometimes it's the third or it's the fourth. So you'll normally have, when you get a stock that's in a strong uptrend and you're in a bull market, you're going to have a bunch of opportunities. There's some stocks that I traded 10 or 15 times out of various VCP setups along the way of a big secular move and strung together a very big return. Again, just going back and recapping again, when we have the contractions, when you start getting into the 4 or 5 contractions, you're going to usually get into the larger bases. They'll be deeper, and then they'll need more time. So that's sort of a relative. You got to think you got to think in relative terms. When you have the larger bases, you want to see more iterations and more time frame to go through that. But here's the one thing you have to be careful of. You got to be cautious when